this is the problem when you're short and everyone's short. You're all kind of like waiting for someone to react. And when someone reacts, then you react too. And you just, that's how it works. It's a very herd market. Hi everyone, welcome to another episode of World of Oil Derivatives, another market episode. I'm Greg Newman, Group Chief Executive, Onyx Capital Group, joined with Martha, Vincent and James. Nothing to say really, get straight into it. Vincent, what's been going on?
Let's get into it. So a really strong week for crude flat price. Brent is up to $87 at the time of recording. It's been one week direction up. So later CFTC data showed market that became very much more balanced and neutral in terms of positioning. And now is the time for the real bulls to take real action with legacy length and new entrants aligning on this. So it's not only the flat price that's rallying, but also in Brent spreads and the time structure. So the backwardatation is strengthening, which indicates that traders are really positioning for summer demand and a tighter crude oil market. Yet at the same time, we're yet to see indicators of this. So whether actual demand materializes, it's anyone's guess. That's what we're looking out for the next few months.
Yeah, I think that last Hail Mary into last expiry was, has held everything back up in the crude markets, dated Brent, and it's now followed through. So I get your point. Very prompt dated Brents, the front time spread, that is very indicative of physical strength, at least in the North Sea. So it's a good summary and quite surprising. So I think maybe to shake it up a little bit, like James, from the, if this is a macro move upwards, how are we looking macro-wise? Is it in line?
Not really. We've had weaker data the last 2 days. China, the manufacturing ISM survey fell for a second month in a row and still in contraction. Service activity fell to a 5-month low. And then yesterday we had US ISM came out, again, lower than expected, in contraction. 48.5, it's been in contraction for all but 1 month since October 2022.
And this is key for you, right? I mean, you're big on employment as an indicator of macro strength or weakness, but manufacturing is not.
Manufacturing activity, it's a third of the size of services, and it's a service sector that's keeping the economy going. But from a commodities point of view, it's manufacturing that's critical. And actually on that, we have this Friday, we have payrolls. So we have the employment data coming out, which will give us more indication of where the economy is going. But the economy, it's just ticking along. It's still positive, but the growth is slowing. So estimates for GDP in the second quarter, the Federal Reserve, the central bank, have regional divisions, and their estimates are being revised lower. The main two, Atlanta Fed has revised their Q2 GDP down from 4% to 1.7, and St. Louis Fed is much lower. It's coming in at 0.75. So the economy, it's not weak enough for the central bank to start cutting rates yet, but data this week is looking weak, and it could be employment data that is the final nail in the coffin.
And how much do you think this is a driver for actual policy? Because of course, say the Biden administration will be concerned, but at the end of the day, they're looking at the stock market as well, right? And they're looking at commodity prices, and they're probably not too concerned with inflation and equity, no? Yeah,
they're not too concerned with inflation. The PCE inflation data last Friday came out dead on expectations, 2.6%. So inflation is waning. We've seen like this morning, German inflation, South Korean inflation surprise to the downside. So it's getting to that level where they can look at cutting. The market's got one cut fully priced for November. September's got 17 basis points of cuts. So there's a trade there. From a bond market perspective, if you think they're going to be cutting more aggressively, you could receive, or if you think they don't cut, they can be higher for longer than paying the 6-month OAS.
But if you like, it's a bit of a stealth weakness for people who aren't as educated on the macro side. They're looking at just the headline equity figures, and it's just everyone's still making money, really, if in long-only portfolios. So how will this be felt, do you think, in the markets, if it does persist, the weakness?
I think what will happen if when we start to see unemployment trend up, then there'll be much more concern that the Fed need to cut. Then the headlines will come in about talking about recession, then the market will feel it.
So employment figures start to worry investors, they pull out of equities, but it probably will be an equity sell-off that will lead to reactions.
And house prices as well. The new home inventory is at the highest level since 2009. There's another market there that's potentially looking very weak. But equities, for sure we've had, Airbus has been very weak this last week, but the Nasdaq's up 20% in 2.5 months. That's a crazy move. But we've seen, Nvidia was a leader. We've talked about it a lot. Briefly last week, that was down 20%. It's now down about 15% from the highs.
But so many retail traders now, especially in the US, so many people taking charge of their investments. That means a lot of people are making money.
Yep. And again, retail traders, do they look at this sort of data? Are they just trying to find the next, whatever, Bitcoin or Nvidia or...
But if they, quotation marks, doing well as a majority, then doesn't that give them more spending power in theory? Not necessarily that they'll use right now, but in their coffers, right? I mean, if they're doing well on equities, and that's primarily where their money's going.
Yeah, but if they're looking at the P&L, as soon as the equity market starts to fall...
This is what I'm saying. So we need to see the equity market fall for people to really get concerned and see this as a potential long-term trend down.
Yeah. The key level on that, on the NASDAQ Composite Index, there was a brief retracement last week to 17,500 and it bounced, but it couldn't make a new high. So if it comes back down and breaks below that 17,500, that's where stops will get triggered. Longs will take profit, and then you get more momentum selling.
I mean, yeah, it's right to focus on US-China, the biggest demand regions for oil. And it's just, I guess, Martha, now, if we could talk about margins and the products, but just before that, like US ultimately are doing, they're in their summer season, driving season. This is what it's always been about. This year, it just gives me the distinct feeling, like I said, like a Hail Mary last month. Markets are catching up. Finally, it looks like it's following through, but it gives me the distinct feeling that it's like, because all the positioning is in Q3 and now we're in Q3, the market's done enough to keep it up here to see out Q3 in a reasonable, strong sense. But as soon as that's monetized and priced out, it can give way, right? And ultimately, from what James is saying and what we've been looking at, S&D, things like that, it just doesn't look like the support is there. Is that still what we're thinking?
Yeah, I think with the positioning that you mentioned, the CFTC, looking at the CFTC reports for RBOB and heating oil in the States, they're both at really massive extremes, which just is kind of tempting this short squeeze position in RBOB especially. So RBOB...
Really short, is it?
Yeah, so RBOB last week saw the highest, the week before last, like the CFTC before last, saw the highest short positions by money managers in 5 years. And there was a little decrease of that this week. But I mean, that's a lot of room for a squeeze there.
And that's quite ballsy. I mean, you wouldn't expect hedge funds being short, especially when hurricane season's around the corner, driving season's right now.
Yeah, I think the general feeling of the market in gasoline is just a feeling of trepidation because of what we mentioned last week about people being so badly burnt. Yeah. But I think that this is seems to be like the lack of liquidity, the really, really short positioning. It leaves a lot of room to gap up, and it could be a really reactive market. There's so many moving parts. I know we always mention hurricanes, refineries, but I mean, already in refinery news, we've seen this morning a fire at Chiba, and last week a fire at Dangote, which didn't turn out to be too bad in the end. But I think there was an injury at the Chiba one. But I think the problem with refineries this year, the focus in refineries this year is going to be in Europe. The Med especially is where there are lots of forecast heat waves. And this, of course, has a really big impact on the FCC unit in particular. So gasoline, and then also, I guess, like VGO 0.5 gas oil. But I think there's a lot of room to gap up in gasoline. It's just a bit of as you said, it's a bit shocking.
It is. It's quite ballsy. And this is like why they used to call RBOB like the widowmaker. They call a lot of contracts that. But in particular, this is where people have lost a lot of money. It gives me the sense of like that adage, markets either overbought, oversold, constant state of that. And people were overbuying products all this year, got very burnt maybe in May, and now maybe we're going to an oversold, which that's actually very interesting to hear. But I'm curious because RBOB is obviously a US contract and it's dominated by US players. And for them to be so short is usually a reaction on the macro side. They're very reactive to macro indicators. So does that add up, James? I mean, I guess it does to what you're saying, but is there the retail sales, for example, or is there anything else to indicate why you would be so bearish at this point on gasoline?
Yeah, retail sales has been weak. We discussed it a couple of months ago going into driving season. Consumer confidence is lower than expected. Yeah, so what do you do when you're struggling? People are taking on second and third jobs. You cut back on
But it's just interesting you're saying, and I agree with you, that do people really react to the more nuanced data on a larger sense, especially slower moving macro investors or even retail investors? So it's interesting to consider what hedge funds are getting short on the back of, unless it's just a pure momentum play from CTAs, for example, which is very possible actually.
I think states-wise, looking at the demand indicators, we've seen so many like bullish headlines that the market just hasn't reacted to, and I guess that just gives a bit more kind of credence to like a bearish momentum. But we have seen, or was it last week, the week before, we saw the draw in gasoline? Yeah, and then it went back to a build last week of 2.6 million. So, I mean, we're getting good travel like optimism with driving and flying, with the TSA and AAA forecasting record levels of travel for July the 4th. But we're not seeing the reaction for this, and we have seen these headlines for last week and the week before, all the way through the summer season. And like how far into the season do we have to get for the market to react? So I think like jet fuel in Europe is weak, and we're seeing these really strong headlines, and it's just.
There's two indices, Economic Surprise Index, one from Bloomberg, one from Citibank, and they both turned sharply lower on May 15th. And I think that's when gasoline started to fall. But it's the lowest it's been in quite literally decades. So the economic data is coming out much worse than expected consistently now. And that could be what hedge funds are trading.
Interesting. I mean, outside of gasoline then, Martha, I mean, what was surprising me last couple of weeks, end of June, was actually the reversal of the propane weakness. It's actually been very strong, particularly out of the US. Is there, or the general light end market? What's going on there?
Yeah, we're seeing better petchem demand. So FEI, the Asian benchmark, seeing better benzene margins. So the midway through this month, I believe the benzene margin dips negative, which then kind of has a cyclical effect in providing support, and rising prices in other petchems. And that's been because the naphtha kind of gets support from that propane when they move up together. And we've seen good naphtha strength. Recently, I think it's broken through the ceiling and flat price of $700 metric ton, which I think people it gives more optimism again. It's broken this like financial level, and people are happy to be buying naphtha. I think there was a bit of confusion at first that there was this fairly significant disconnect between the financial and the physical. I know that we were a bit taken aback by it, that there's poor gasoline demand, there's like little blending demand, gas naph's falling like really significantly, and then petchem demand, I think it's strong, but it's definitely interesting to see that it has been supported past these high levels, and then there is demand for it.
Well, it's telling you something's going on in the positioning, right?
Yeah.
Propane's not a huge market. It's dictated by quite a relatively few number of individuals, and I think there was a short squeeze at the very beginning of the year. And I think a lot of the markets like essentially worn those shorts back down. So even when you have the market, essentially pricing what we would have thought is fair value once we were building again for summer, at the end of the day, the market's still short. So, I mean, I was even hearing that there was these build stats coming out of the US, and people were buying because it wasn't building enough, which is a bit crazy because it's pretty significantly above the 5-year average, or at least enough above the 5-year average that it's not exactly a cause for concern. But this is the problem when you're short and everyone's short. You're all kind of like waiting for someone to react, and when someone reacts, then you react too, and that's how it works. It's a very herd market. So
I guess interesting to keep an eye on the Panama Canal there. So that's having more crossings. The levels are really good, but if that dries up, then that could lead to a bit of pooling in the States.
Well, because the Gulf Coast stocks have been low. I think that is like what I would say. It does make sense fundamentally, as in the stocks might be building in propane where they're being where it's being produced, Dakota, etc. But in the Gulf Coast where it's actually been exported, and the Panama Canal had its issues, auction prices were very high. They've come lower, and stocks are low in Gulf Coast. So I guess that's the excuse. But it does seem like a very herd-driven rally, and I think it is pretty indicative of propane. So we'll probably go back down again. Having said that, I know what you mean about the petchem and naphtha flat prices. I mean, it's the lighter you go, like the more disconnected you get from a correlation point of view with crude flat price, right? So at the same time, everyone's margins, they're not thinking about it like so simply, right? Like a naphtha crack. They're looking at, retail flat price margins and where they can buy their wholesale price relative to that. And so when flat price weakens, Brent weakens, or when it did weaken a few weeks back, then it was probably a lot of opportunistic buying, and that was what we heard, right? And the Chinese are all over the place because, 1 minute we're saying, oh, it's the most bearish ever, then we're saying it's not as bearish, and it's been chopping and changing. But again, it's this lead lag thing. So now James is saying, okay, the Chinese data is looking poor again, but the Chinese are massively on the buy side of the main crude benchmarks to buy. They don't seem as bearish anymore in the North Sea where they were. There's petchem buying, as you say, there's propane buying, all Chinese led. So I guess that's kind of indicating the data we will see in a couple of months is going to be stronger out of China.
But the flip side of that is the Chinese bonds keep making new lows. In fact, this week the yields traded at all-time lows, and yesterday the central bank had to sort of step into the market to try and prop the market up.
But that's their own. I mean, they don't want any foreign investment, right? And they've scared everyone away. So that's not that surprising, don't you think?
Yeah, but if we're expecting some strength in the economy going forward, you'd expect to start to see yields pushing higher.
Well, strength in the economy, strength in manufacturing. But I remember we spoke about this a few months ago about like the idea of them exporting deflation, and they're going to do that on the manufacturing sector, right? So we're really kind of like narrowing in on the manufacturing rather than the global economy. Sorry, the wider economy.
True, but if you're going back to China, we've seen in the last 2 days a huge steepening in the US yield curve, the 2s, 10s. And that's because of basically the presidential elections, a debate. The market's now seeing Trump being victorious, and one of his main aims is a 10% tariff on imports, which will hurt China significantly.
That's actually a very good point. So you would expect, what does that mean for propane? I mean, at the end of the day, you would expect the Chinese, all the import contracts so that is naphtha, that is fuel oil, and that is rallying, and that is propane. So those three markets mainly, they're a net importing market into East from the West. So that would actually make a lot of sense that they're kind of accelerating their buying now. But at some point, it's bearish for the US because ultimately they export so much of the propane, NGLs and all that, and they won't be able to in a tariff situation, and they'll probably have to send it more to Europe. So East-Wests, I'm getting a bit technical, but I think it's the East-West that need to rally in that scenario. But actually that does make a fair amount of sense. So you think it's almost like planning ahead, and everyone can see the same things no matter where you are in the world, right? I mean, these two big economies, everything they do impacts everyone else. Absolutely. So the election is going to drive manufacturing decisions. It's weird to think about, but it's got to be true.
I saw an article recently is that in terms of the NGLs and propane, it's one of the few parts that China and the US are becoming increasingly interdependent, especially with more of the more PDH plants coming online in China, and then a lot of that demand is coming from China demanding US propane, and then you also got the Saudis, Middle Eastern producers also competing with the US for that East Asia demand.
That's interesting. So you've then got the CP contract. So it's FEI versus CP, comparing that with LST versus the US versus the Asia, and that dynamic is going on all the time. But we have had some surprising strength in CP, which I guess backs up with what you're saying. But then you see that, okay, you start buying CP, US gets a lot lower, then it incentivizes that again. And at the end of the day, oil traders don't care about like what Chinese would prefer them to buy. They're going to buy the most cheap propane. So they might be competing, but it doesn't seem, at least, given the flexibility the Saudis have with setting their own benchmark, they don't seem to be setting CP that low. They need to be aggressively setting that lower relative to FEI to compete with the US. So maybe that's a predictive thing. If they want to be more competitive towards the end of the year, they need to really ratchet that down. Or maybe they're thinking we don't need to, because the tariffs will add, and we should do that maths. If you add 10% tariff on US LST imports into China, how does that then compete with the price of CP into China? Do you see what I mean? That'll be an interesting one. All right, so Googling oil then, what are the main things being talked about in the wider market?
So you have Reuters article, Trafigura Gunvor demand sparks jump in Brent oil benchmark. So this is in regards to the bull plan data Brent over the past month. So interesting enough also, so in this article talks about whether if the bull play played a role in actually lifting up the flat price of Brent crude futures. Obviously it had an impact on the Brent spread structure backwardation, but perhaps it led to, it was part of the wider bullish momentum in Brent Futures anyways at the time, also quotes our very own Jorge Montepec, mentioning that the latest trading activity coincided with thin supply of North Sea grades due to summer oil field maintenance.
Is this quoting his reports on LinkedIn or quoting directly?
I believe it's kind of
A hybrid.
hybrid, yes, hybrids.
Okay. No, it is interesting. And saying is one linked to the other? Well, the answer in short is no. But yes, in terms of if you're trading correlations, then there's a lot of people who trade Brent spread versus flat price correlations. So if they see Brent going up, they're going to buy flat price, vice versa. And then they'll trade the ratio. So if you trade 100 kb of flat price versus, whatever it is, 250, 300 kb of a front spread, so you have a correlation like that, then you might mean revert that correlation when it goes to extremes, or you might just use it as a momentum indicator. So if the North Sea is strong, it's a bullish fundamental indicator and it's a bullish technical indicator, and people buy flat price off the back of that. So it is linked because of people's behavior. It's all about what people choose to react to at the end of the day. And I think it's also indicative of they're reacting to that momentum strength on the underlying and technical, and we're in a relatively balanced positioned market, so it will have an impact. Do you see what I mean? Whereas if this happened, a few months back, people are too long, let's say, then I doubt it would have as much of an impact. Is I think basically the answer. Yeah. Anything else?
Interesting. Yeah. Another one that came out also recently. So this is talking about the Budget Committee initiates probe into suspected collusion between Big Oil and OPEC. So Senate Budget Committee Chairman Sheldon Whitehouse has launched investigation
Still
demanding.
going on with this?
Yeah, so this came out last week. So basically, they were demanding answers from the CEOs of 18 American oil producers about efforts to collude with OPEC. I quote, that would artificially raise prices on American consumers and increase costs for the federal government. So this follows revelations from the FTC that former Pioneer CEO Scott Sheffield attempted to work with OPEC to manipulate global oil and gas production. So yeah, this does sound like it's a headline perhaps coming out a few months before the elections. It's more from the perspective of
It's anti-oil, yeah.
Anti-oil for like what the average Joe thinks, right?
Yeah.
And all of that.
I mean, Scott Sheffield doesn't care. I mean, from what I've seen, he's very outspoken. He'll say his opinion, and I don't think he'll have any fears. So that'd be an interesting one. I think it's a poor battle to fight. If you don't really understand oil markets, which clearly they don't, then you're just gonna run the risk of looking stupid. But then again, are people actually going to look at the transcript of that and get into it? They're probably just going to see the headline and just believe it, right?
Yeah, it's all about perceptions and what the
perception
public
is reality. Yeah. That's what Jorge was saying this morning. Okay, last week we did a poll about this dated Brent strength that we have been talking about. Jorge's been very vocal about on his reports. Yeah, it was a Hail Mary throw on expiry. What that means is when Brent expired last month, it's 2 months forward loading, and the guys who buy the oil that is used to set the price for the Brent benchmark gets quite complicated, but ultimately it's a speculative view. They have to buy that at a certain level that they think it will clear at in a couple months' time. So it's as much a speculative thing to do as trading derivatives. But it's important because it does obviously set the benchmark and therefore filters into global oil prices. And to buy, 26 or 27 cargoes of crude at roughly, I think, average, maybe around flat to the benchmark, was a sign that, believed the strength would follow through, and it's happened. I mean, at the end of the day, the debate is now, would that have happened if he'd been buying so aggressively? And that's just like a little bit of a pointless debate because it's the mechanism we've got. And ultimately, if it can sustain through, obviously the market is strong, and now we're on like a big rally in flat price products. So you have to say that Hail Mary was just, I wouldn't call it lucky, but it was at the last throw of the dice and it worked. So we are where we are now. The question we asked on the poll was, will this bullish regime last into July? Because you could say it was just a temporary thing. But most people, 68% said yes. And I think it is, we're in July and it looks pretty damn strong. Doesn't look like we're any threat of weakening. And I think, just to repeat what I said earlier, I think, at least my view of it is trader positioning has been so concentrated in crude and product in Q3. That doesn't just mean their derivative position. It means that they've been thinking about their physical and how they're going to be positioning their physical pricing, their physical loading to, make sure that oil is moving away from the areas that price the benchmark, things like that. So there's a lot of coordination when a big trade house, big major, and the collective industry is bullish, a particular tenor, a particular contract month. So it's very unlikely that we will weaken in the next month or two on that basis. It might weaken, the outright price could weaken because there's a lot of factors that going into there. But things like dated Brent and products relative to the crude futures, I think is unlikely to weaken. However, if it is propped up and it was a bit of a Hail Mary and it's just a temporary thing, then like we said a couple of weeks ago, and I think this is generally our narrative, things propped up, it works until it doesn't, and as soon as you give way, there's a big vacuum, big cliff edge, and that could still happen Q4, which was very similar to 2018. So yeah.
I think probably worth mentioning this week, big event in the wider financial markets. There's US payrolls, but we also have French elections, UK elections, and the ongoing Biden-Trump saga, which could add some volatility to markets.
Well, it already has. I think the power markets, French versus Germany interconnector there, that caused absolute mayhem. I think the spread that was, I don't have the levels in mind, but it basically blew out. And I think it was short Germany over France. And that level has now gone super, super high. And a lot of hedge funds have been killed on the back of it. So, okay, it's hard to link it directly to elections, but it shows like different policies with power, such an efficient market, so heavily linked interconnectors, all that has already shown how volatile it can be. So there could be a lot more of that, right?
Absolutely. And such a big move in the 2-10 yield curve off just the back of perception that Donald Trump will come in.
Yeah, I would say, just to reiterate that point, I mean, oil markets, okay, maybe from a refinery perspective. So Totz's refineries in France, when there's strikes, it has a big impact in the European product market. Okay, so that's quite possible to make a difference. But I think the wider oil market, I don't expect the elections to have much of an impact, if any. However, if you have it as part of a contagion theory, whatever's going on with people's mindsets the second half of the year as all these elections start coming through, does that mean more disquiet? Does that mean more tariffs and kind of, what would you call it, like the reverse of globalization, right? So
deglobalization.
Protectionism. Yeah, so if that's becoming more of the theme. Anti-immigration, like more localized policies, protective policies, then that will impact trade. But we're talking about differentials here. We're talking about which you can obviously trade very effectively, but in terms of the outright price, it will probably remain unaffected, I would say, by these factors. I think we still need to think of, is the outright price strong in the face of macroeconomic weakness?
Yeah, the one area I could maybe link it to oil would be if Le Pen is victorious in France, if French bonds are widening out, the euro could take a dip and the dollar strengthen.
Yeah, no.
It's looking at several steps.
Yeah.
But the dollar strengthening because the 55% of the dollar index is euro.
If we can get collective positioning to be bearish, then obviously it's going to sell down oil. But I think we already had that reaction in hedge funds and financial players, and it got absorbed. So I think we need to see the trade houses and majors really flip around their positions because they're clearly holding a lot of that length. And the fact that the market wasn't able to fall despite record shorts, or at least like record in the last 4 years, that shows that they're there on the bid. So if they see out the summer strong, monetize that, then there's no reason for them to buy the new wash of selling flows if they do come with things like the elections. So yeah, I can see your point. It's a kind of a contagion concept. Okay, so we'll leave it there. Thank you everyone for tuning in. Really appreciate your support as always. Just quick reminder, we do have quite a few special episodes out at the moment. There was a Onyx white paper, how valid is the CFTC COT data in analyzing trader positioning in oil derivatives. That was a long discussion we had and very in depth. I think it's a very interesting one. It's very important as we trader positioning becomes more and more important, as we always discuss. And I did a leadership episode with Omar, my partner and co-founder at Onyx, and that's worth checking out as well. And other than that, we will see you soon. We've got James Brody's Macro Monday still going strong as well. Be sure to check that out. And we'll see you again in World of Oil Derivatives very soon. Thank you.